I mean, if you look at the deliveries that are going on in the futures markets, we normally see maybe 2% of futures contracts end up going to delivery. It's now up around 8%, so 4 times. At the end of the day, the industry as a whole does just not have the capacity to handle mass market coin buying.
Please join us for our next live stream, Sunday, August 16th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, August 16th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to this channel or you have not already done so, please do subscribe, hit the bell to be notified on new updates, and give us a thumbs up if you like what we do. We really do appreciate your support. Bron Suchecki is here with us today. Bron is a precious metals analyst with ABC Bullion in Australia. His career in the precious metals industry spans more than 20 years, of which 19 years were with the Perth Mint. And we're delighted to have Bron here today as our guest. It's time to saddle up and silver up for Bron Suchecki. Bron, welcome to SBTV. How are you doing?
Good, mate. Thanks for having me back.
Glad to have you back. Really glad to have you back. It's been a while. 2020, what a year it's been so far. It was largely negative for the global economy, and we are still witnessing the fallout from the bug, COVID-19, this crisis today, especially as many companies, some well-known, are even closing down now due to the financial strain from the fallen economic activity. Can you share with us your thoughts of 2020 and maybe so far what has, frankly speaking, maybe been a shock to you, and if you see any silver lining in the rest of the year?
Yeah, is that silver lining? Is that a cue for me? Is it on silver?
It might be.
Look, I tell you what, I think the Mayan calendar was supposed to finish in 2012, and then I heard that the date was wrong and it was supposed to be 2020. Well, the world probably hasn't ended, but it certainly feels like it, doesn't it? I mean, we started obviously the year, I suppose, with normal and sort of expectations, although the gold market had been sort of building a base, which I think people have sort of forgotten in this spike, that gold actually based in 2016. And then when it got through that 1700 level, it really started to grow, but it had been building for a long time. So there were a lot of fundamental reasons behind gold, and a lot of institutions, smart money, were getting in. And so at the beginning of the year, we sort of I thought it would be a continuation of that, a nice slow grind up, the gold price would build strongly. And then I saw on the LBMA, Ross Norman, on his forecast, they have all the professional market experts put their forecast in, and he was there with 2000. And at that time, the beginning of the year in January, I mean, we all thought, well, that's a bit of a stretch, and how wrong have we been proven? And then obviously, look, COVID was the main trigger for a rethink. But it just seems, I mean, even this recent, Beirut explosion, I mean, it's just been a year of absolutely crazy occurrences. I think what we're seeing now, certainly we at ABC Bullion saw a lot of account openings on March because of COVID. Interestingly, there were a fair percentage of them opened but didn't end up buying. And then what we've seen now, because, they sort of like, oh, something's happening. And we find that generally there's a certain smaller percentage of clients that open that don't buy. And but what's happened with this second wave, which has coincided not just as a second sort of wave in the US, but in Australia as well, and a few other countries. But we've also seen the price move up, is that a lot of those people that opened accounts are now buying. So that's that real trigger for them to go, right, I better get in. So I think that's what's been driving the price quite a bit. And I mean, all of those factors, the US dollar sort of weakening, but it's more weakening because of the money printing that not just the US, but other governments have having to do to keep on top of the coronavirus impact on the economy. And so that's raised concerns about money printing, obviously, and that's starting to feed out. I mean, obviously, gold buyers and silver buyers are already aware of the money printing and the risks of that, but that's now filtering out, I think, into the general public. So that's sort of driving it as well. But yeah, so lower interest rates, negative rates, All of those factors are now sort of combining to create this really surge, giving a lot of people sort of a lot of ticks, tick this, tick that, in terms of the factors of trying to protect themselves with precious metals.
Okay, so overall, how do you see the Australian economy? Is it encountering some headwinds, or are people just still kind of chugging along?
Look, I think before we had an outbreak down south in Victoria with the second wave outbreak there due to incompetence of the government in sort of managing quarantine in hotels, I think the mood was turning around. I mean, unemployment numbers were still quite high. Possibly sort of, I don't like unemployment, I like underemployment, because, people might have a job and they're working 1 day a week, but then they'd rather work 5. But those figures officially about 12%. I think other statistics, other survey firms have it up a bit higher, around 15 or 16%. I mean, that's a lot of people that, are not being gainfully employed, and so that puts a hit to the economy and spending power, which is why governments have had to, come up with its stimulus measures. Australia's been okay, although we are quite reliant on travellers in for tourism as well as for foreign students that come here to study. So those sectors have taken a beating. But the reality is that exports, we're mainly a export-driven sort of commodity country, and that's not really been affected, be it iron ore or gold or other commodities. We're still exporting quite a bit. So our sort of trade balance is actually doing well, because we are still exporting dollars out, and if anything, imports are sort of restricted a little bit because people aren't spending. And so the Aussie dollar's sort of strengthened a little bit, reflecting that. But I think this second wave has sort of put a bit more fear into people, and they've realised that this corona impact is just going to keep on dragging on. It's not a quick fix. It's not like, we can all sort of lock ourselves in the home and then magically the virus disappears. It doesn't. It's still out there, So I think that sort of may hit consumer sentiment going forward.
Okay, you mentioned second wave. So far, how does this second wave compare to the first wave?
Look, it's not as big. I mean, if you look at the charts, it's not as dramatic, and it is at the moment isolated just down in the state of Victoria. But it's the concern that how rapidly it has grown, and that's why they've really went into very extreme lockdown measures down there. So I think that's really sort of brought home the ease of transmission of the virus and the fact that it can get spreading very quickly. So it looks like it's being contained, but it's certainly causing a bit of concern for, I think, people in general.
Okay, we'll be hoping for the best with you and everyone in Australia. But
Yeah.
Bron, given that you are based in Australia, which has two well-known refineries, Perth Mint and ABC Refinery, which you both of them you know very well. How was Australia affected by the precious metal squeeze that happened in the first half of 2020, and were both refineries able to keep up with the physical demand?
Yeah, well, it was because we are a commodity sort of reliant country, commodity production was considered essential service. I mean, obviously, if we weren't exporting and generating, dollars to bring into export income, it would really have made the economic hit from COVID really bad. So the government was very much about prioritising the workforce measures to allow people to continue to fly out to mine sites and continue to produce. And as part of that, the refineries were deemed also essential, because obviously there's no point producing the gold if you can't refine it and you can't sell it. Both Perth Mint and ABC Refinery continued to operate. And indeed, we saw a huge sort of surge, both at retail level and also at the wholesale level for metal, because Australia is a big exporter. We obviously second largest gold producer in the world, and obviously our population is quite small, so most of our gold is exported. So we did still continue to see exports, although the flight restrictions really did start to make it difficult to get metal moved around. But we have good relationships with the carriers. We're able to sort of keep exporting.
Okay. Were the refineries prioritizing the fabrication of the larger bars or maybe the smaller items like coins?
Look, we make more money selling smaller bars, right, than we do shipping, a ton of kilo bars into Asia or 400-ounce bars into London. So priority is always on small bars. the issue for us is that it's a lot easier. For example, you can imagine making one 400-ounce bar to pour that compared to pouring 400 1-ounce bars. It's a lot more production time. And so we have limited capacity on production. We just bought a brand new automatic barring machine, fully automated, a number of months ago. And we thought that was giving us plenty of capacity, but this hit, that was maxed out, running 24 hours a day, and we still haven't been able to keep up. So sort of supplies have been restricted domestically purely because of that production capacity of the machine to make bars and coins. Not so much on the refining side. We've got the capacity to refine and make the large bars and ship that out. But yeah, so we're certainly prioritising all of our production capacity on small bars as much as we can.
Yeah, that's a good point, something to think about. What do you make of the bifurcation of the spot prices and physical prices, which is still happening today with premiums where they continue to be higher than before the COVID-19 crisis began?
Yeah, look, I think that that was that really was unprecedented. And I think, to be honest, probably embarrassing for the professional markets because, the behind the scenes arbitrage that goes on between London and New York and effectively keeps prices in all markets tied together. Because ultimately, if the price in one market surges up, there's a profit where you can sell metal, buy metal at the cheaper market and then ship it and sell it at the higher price. It's free money. And normally that trade occurs, but it's not really visible because it might be on the order of 50 cents or $1 an ounce, on a $2,000 an ounce price. It's not visible to normal people, but there is a little arbitrage that goes on as demand fluctuates between London, New York, Australia, China. Metal is shipped, bullion banks sort of buy it in one location and ship it to another. And so that is going on all the time. But then that split that happened between London and New York was quite massive. And really, it showed the breakdown. And I think the initial cause was the restriction of freighting. Because obviously, if you can't fly gold around, you can't sort of execute that arbitrage to move it, right? And what we were seeing was a lot of demand in the US, institutionally driven, in my view, as well as futures markets, but a lot of demand in the US. And so that price is starting to get pushed up. But if you have flight restrictions, then it's not possible to get the metal out of London and fly it into the US. And then on top of that, you had refineries shutting down and in Switzerland because of COVID and because they're so close to the Italian border. So you had both a sort of inability to transform bars and then also an inability to fly it. And that's what caused that initial price break. Now, it has come back, but you're right, it's still elevated and it still pops up every now and then. If there's a bit of a surge, you see that spread widening between London and New York. And I think what's really playing there, which is something that was ignored, I think a lot of emphasis was put on the freight issue and the refinery shutdowns. They're not so much a factor now. But what else was coming into play was the financing cost, because you got to think about the trade, right? I'm a bank or I'm a trader in a bullion bank. I've got to sort of borrow money internally from the bank. The bank's got a limited sort of pool, and the trader says, hey, I want to borrow, $100 million or use $100 million of the bank's money, tie up that capital to buy some gold and then ship it for X number of weeks into this other market and sell it. And so the bank looks at that and goes, well, how much money are you going to make from that versus what else can I do with this money? Now, the arbitrage spreads, the gaps in those prices were quite significant. But even then, you're seeing that banks weren't willing to step in. So when that gap starts to widen, and there is freight capacity and refineries are able to convert bars, then what it must be telling us is that the financing cost or the cost of money to a bank or their liquidity or their ability is actually restricted. Their funding cost is higher or they don't have as much capacity. Because what's happening is the trader on the bullion side is going, hey, I want to use some capital to execute this arbitrage, and the bank treasury is basically saying, no, we need this cash or this money for this trade or to settle these margin calls or whatever other purposes where they're much more desperately required. So I think that's part that's really interesting, which people haven't sort of focused on. And so when we see that wider spreads, it's telling us there's still a bit of stress in the financial systems. Things aren't as liquid as they used to be. Otherwise, these price arbitrages would close up.
Yeah, it's another great point, Bron. I mean, I think most of us were looking at supply and shipment as being the problem, not necessarily the financing of it. But Bron, do you think that the physical market is starting to break the paper gold market?
Yes, the long called for. When's it going to break? Look, I won't say it's breaking it now, but I think that there's certainly a lot of pressure being applied. I mean, if you look at the deliveries that are going on in the futures markets, we normally see maybe 2% of futures contracts end up going to delivery. It's now up around 8%, so 4 times. So 8% is still not like, 50% of the futures contracts. But if you think about it, if you're a bank or a trader and you're expecting normally around 2% of contracts to go to delivery, you base the amount of stock you have in warehouses and your positions that you're trading around that. And then if all of a sudden it goes 4 times, well, you might find people getting caught out, and that can explain, some of the price dislocations that we've seen. So I certainly think that the paper markets are sort of being put under a bit of pressure. But what it is, I mean, you've got to remember that futures markets are both legitimate sort of hedging markets for dealers like ourselves, right, where we would hedge off risk. But they're also purely speculative. And what I think we're seeing, particularly with the higher standard deliveries, means that a lot more institutional market players are saying, I'd rather take physical and hold physical rather than roll a futures contract. And there's a few things that could be going on there. It could be they're worried about the risk of default or not being able to get the gold in a futures contract, so they'd rather the physical. But the other factor is that because of the spreads that you just mentioned and the funding costs, the cost to roll your contract into the next active month, there's a cost to that, and that cost has actually widened. And so the banks and the traders look at that and they go, actually, you know what? The cost of an ETF at 40 basis points or 25 basis points, 0.25%, compared to the roll cost, it's actually cheaper for me to sit in an ETF. So that could be the other thing that's driving it. But ultimately, yes, I think we'd need to see a lot more physical delivery, or COMEX getting a lot more deliveries before we really see it put under stress. And there's been a lot of tonnage. I mean, the US has been shipping in massive amounts, I think 100 tons. It's massive shipments coming from Switzerland into the US. So at the moment, the market's meeting it. But yeah, I mean, if this continues, you've got to wonder how long it will go, because there's only so much sort of free float. And I suppose as the price rises, the longs or people are holding it are less willing to hand it over, less willing to sell. And if people aren't selling into the market, then supply gets constrained and the price gets going up, which is what may be driving it at the moment.
Bron, we're starting to see wholesalers stopping pre-orders for certain silver coins, and it seems that another bout of shortages could be starting up. Have you heard news of physical supplies of gold and silver getting constricted again?
Yeah, look, I think we sell our own products, but we also do, sell other products from other mints, and they have all been putting distributors on rationing. So again, it's a limited capacity issue there, and making a coin, stamping a blank, and then making the blank and then stamping the coin is quite an involved process, a lot more than making a cast bar, for example. So that supply can get under a lot more pressure in terms of limited production capacity. So I have heard of that. We are seeing that. I mean, we'd like to buy a lot more coins of various mints, but we're getting limited sort of supply orders that we have being allocated to us. And I think all dealers are seeing that. And that's going to continue. I mean, at the end of the day, the industry as a whole does just not have the capacity to handle mass market coin buying, in terms of if we really get the mass market coming in. And I wrote about this in 2008 after the GFC, when we saw the same thing, restrictions going on there. Same into 2011. The last bull market, there were a lot of issues with coins. Coin premiums started to rise. I think that's going to be an ongoing feature of the market going forward.
Do you see the gold price hitting new record highs mainly due to the fear trade, where there is a sort of a dread given how bad the real economy is at this moment?
Look, I think it's interesting because I think there is a bit of a fear trade. I think what we've seen is we're still, I mean, it's starting to get mass market coverage, right? So I think what we've seen to date is a lot of people that were already sort of gold aware. They maybe, as I said, opened an account, they have been thinking about it. COVID sort of triggered them into buying. And so this initial surge has been a lot of that money driven by that. We've still got another leg really when we start to see the public really sort of coming in. So, you know, I mean, I suppose until the taxi driver starts really telling you the latest gold stock tip, you know, mining company to buy, we're not there yet. I think what's happening is the average person is seeing the headlines in the newspaper. It might still be in the business pages, not on the front page of the newspaper. It might get a mention on TV in the news. Until we see that, that's when we really will see this, the retail investor pile in. I think that will probably come into ETFs because that's how most people will see it. And to be honest, that's probably the easiest way for most people to buy. We will see a lot of people come into physical, but I said the physical market with a mass market interest is going to really constrain the physical production industry, and those premiums will go up. So, yeah, and so I think the fear trade is there. It's a bit harder for the average mainstream person. I think if you're in precious metals and you've been following it, and you know you watch the videos that you're producing, you're a lot more savvy and aware to these issues. I think the average public is still quite naive about a lot of stuff. So at the moment, I think it's more probably driven by, hey, the gold price is going up. There's been a lot of money in that. Maybe I can make some money out of it. Not so much really thinking about, hey, what's going on with the financial system and money printing. I mean, I have talked to people, you know, some clients are like, yeah, I'm a bit worried about where this money's coming from and how long can the government keep just paying people to do nothing. But I think a lot of it has been, hey, the gold prices went up. It looks like I can make some money out of it. But once those people come in, they will start to read up about gold and they'll start to become educated about other issues around the whole economy and the financial system and the amount of debt that governments have and personal debt levels. And then they may start to turn a little bit more into a sort of a fear trade type of thing at the moment. But at the moment, I think a lot of the money is sort of a FOMO, get in while the price is going up type of mentality.
In one of your recent articles, you mentioned the work of Russell Napier, who believes that we're going to see a 4% nominal inflation in most of the developed world by 2021. Do you share this view, and why would we see a higher inflation when the global economy seems to be in a deflation at this moment?
Yeah, no, I mean, it was a pretty ballsy call, 4%. I mean, central banks have been complaining for decades now that they can't get inflation back to their, I mean, I don't know why 2% is ideal, but that seems to be the magic number, okay? Like, I saw a tweet someone I think said that, you know, if you reword it as the central bank's aim is to increase your cost of living by 2% a year, I mean, the average person would probably go, wait, that's not good. But somehow, you know, falling inflation 2%, but they can't even get 2%. So 4's a really big call by him. Look, it is a competing force at the moment. No doubt that governments have sort of got onto modern monetary theory and feel that they've got that capacity to print, and COVID gives them the excuse to print, which they would love to do anyway, right? And so that force is putting a lot of money into the system. You've got at the same time, as you mentioned, this sort of deflationary impact where people's spending power is constrained. They're not employed, or even if they are employed, they're being conservative and pulling back on spending to save money. And so that sort of puts in a force downward on prices. So you've got these sort of competing inflationary trying to push it up and deflationary type demand destruction, you know, putting pressure downwards on prices. At the moment, I think that the inflationary aspect hasn't really been able to kick in. I'm not sure I'd see it kicking in by 2021 unless things got really crazy government-wise in terms of stimulus measures. So I don't think we're there yet. I think the gold buying and the reaction has been to the potential for inflation, not for the actual reality of it yet. I think when inflation kicks in, then we'll really see a run, and that's probably what will bring the mass market in.
Okay. Can you share with us more about the financial repression, like capital controls, that you also mentioned in your article, and how likely will such a financial repression happen?
Well, we're already in financial repression if you look at interest rates after inflation, right? So the reality is if you put money in the bank, you're going backwards. The interest on the bank does not cover the inflation. So that is a form of financial repression. It's the way in the past it happened after the war when there was a lot of debt after the war. It's how governments bring down the real cost of debt that the economy has sort of, incurred too much debt. The only way, apart from, a debt jubilee or, extreme money printing, the only way really is just to have that negative interest rates that just pushes down the real value of that debt slowly over time. So we've already been in that. We've been in that situation for a while. And I think that's why a lot of savers look at that. They can see they're getting nothing in the bank. And certainly talking to clients, we've seen a lot of clients buying gold because of that. They're like, I don't earn anything in the bank. Gold's got potential to go up. So they look at that and go, okay, may as well move some of that money into gold. I think that we'll probably see, I'd say it's probably going to be a little bit of a while before it accelerates into something a little bit more extreme. I think the economic situation would have to get a lot worse before the government looked at further repression measures like capital controls. I mean, we have that in some countries, okay? So, Malaysia, for example, you've got restrictions on moving out. A lot of countries like that have capital controls already. It's a big move to do that in the Western world, but if debt levels get too high and the economy starts to get really bad, it's a potential. They correlate that and linked to that obviously is the potential, which is raised often about gold confiscation, which I don't think is on the cards because we're not in a gold standard environment. We're not gold, money's not linked to gold, so government doesn't really need gold to inflate. But yeah, there could be other sort of restrictions in terms of capital controls, movement of money out of the country being restricted because to support the currency. That's potential, but I don't see 2021 as a likely date at this point. Maybe a little bit further out, we'll see inflation kicking in.
Super funds and pensions there, how are they doing? Are they starting to get some pressure, or have they been under pressure for a while?
Oh, look, I mean, low rates do put a pressure on the funds, and I mean, some balanced funds. I just saw one of the largest Australian super and the largest funds there, balanced general sort of balanced conservative fund had a 0.5% return for the year. I mean, zero, nothing, because it's got a lot of stocks in there, and stocks have come off and have gone flat. And it has no gold, right? It probably would have had a good return if it had some gold in the portfolio to balance it. So anyone, and we've seen a lot of people coming to us who have either their super and saying, well, how do I get some gold into my pension account? How do I do that? And so we've seen a lot of people opening accounts and also setting up their own super funds, like the IRAs in the US. So, yeah, it's an increasing trend. And I think that whilst interest rates are low, and if the stock market does sort of flatten and turn over, we'll see an increasing trend there. And certainly there's a good case to say that a bit of gold, a bit of bonds, a bit of cash, a bit of stocks is actually an all-round balanced portfolio. And indeed, Harry Brown in the 1970s developed something called the permanent portfolio, which is, and his strategy is basically 25% cash, 25% stocks, 25% bonds, and 25% gold. And you just continually rebalance back to that. And he said each of those asset classes covers different economic scenarios. So cash for deflation, gold for inflation, stocks for growth, and bonds for a sort of depression. So it's a real gap in the pension, the mainstream pension superannuation plans, that they really don't have any allocation to gold. And that's driving people out of that system and into managing their own money.
The gold silver ratio has retreated just from a few months back, where it was about 125 to 1, all the way down to about 75 or 80 to 1, where it is now. It's sort of bouncing back and forth between those numbers. While gold has exceeded the previous record high, why is silver still lagging?
Yeah, and look, it is, and silver has been sort of a sideways market for a really long time. I think, look, COVID no doubt did impact it because silver's got a significant industrial demand. And so the initial response with COVID was not really favourable towards silver because I think a lot of the institutional investors looked at it and said, oh, it's an industrial metal. They didn't really see the monetary aspect of it. And so they were like, okay, I'm not going to buy that. If anything, probably sell it. So silver sort of lagged. But I think the market, with gold having a run up and the sort of common knowledge that silver moves with gold and usually moves leveraged, I think the price sort of performance gap between the two became too obvious. And so that's why we've seen silver surging now, where it's trying to catch up because institutional investors have said, hey, silver's undervalued in relative terms. So yeah, that ratio's come down from 130 down to 70, the high 70s. I mean, the outlook for it, I was speaking to Nick Frappel, our technical expert. He sees that there's targets getting down into the 67, into the low 70s at this point. So it still has some potential for silver to outperform, although you'd have to think that with the run that it's had so far, I mean, for it to continue to outperform gold, would really have a significant move. So I wouldn't be surprised to see it consolidate in the 70 number and sort of, build a base there and let some time build up before gold's next surge and silver runs with it. We then may see that ratio push down into the 60s.
Wow. Okay, that's a pretty significant change. It's more than half of where it was just a few months ago. Your opinion, is silver a better buy right now compared to gold? And how would you advise clients who ask you this question?
Look, it's a tough one. I certainly, when it was at 80 and 100 ratio, I was saying, yeah, it certainly was really undervalued. It's a little bit hard to call because the ratio stayed at 80 for a long time. And so whilst historically gold-silver ratio has been down to 40, and the expectation would be that in the long run it would get back down to that point as part of a general cycle, because if you look at the ratio, it has these cycles. I think right now it's had such a real run that there is a little bit of a risk of silver sort of underperforming slightly or just pegging with gold at the moment. So I don't think it's the case for silver relative to gold is as strong as it used to be. And any other caution, I mean, I wouldn't say that, you don't buy silver. I think that there's a case to mix both of those things into the portfolio. You just have to be careful because, silver and gold move together, but they also move together on the downside. And I still think, I can't call the top. This market feels very bubbly, feels very top-ish. It's hard to know with momentum how long that momentum will run for, but I wouldn't be surprised to see both of them come off a bit, consolidate at a lower level, which would provide a good buying opportunity. And I certainly think that putting a mix of gold and silver into the portfolio would be a wise move.
Okay. Bron, you've seen a lot in your time in the precious metals industry. You've seen a lot of things going on with economics and finance. What is one thing, probably the most important thing you would like to share with people or to let them to know?
Look, I think the main thing that I've seen is that not to get caught up too much, I think, in the price gains or even the price losses. I think a lot of people buy gold. If you're buying gold because you want to make that fast buck and, make a huge profit, you probably end up being disappointed because it is a little bit more volatile. It will go up, it will go down. I think you've got to have the mentality that it's there for insurance in the portfolio. It's there to provide that protection. And just like with any insurance contract, you don't sort of finish the year and go, what a waste of money that was having that home insurance. My house didn't burn down. I'm never buying home insurance again. I mean, you accept that you spent that insurance money and you lost it. And so in some sense, you've got to have a mental sort of approach with precious metals to go, if they go down, it's not the end of the world. Gold is still doing what it needs to do in the portfolio. And you need it for times like this when it goes up. So it is good to have a bit in the portfolio. Don't get too fixated on the price. Don't worry too much about the movements. If you are worrying too much about the price dropping off, then maybe you've got too much as a percentage of your investments. You should be comfortable to say, you know what, I like it to go up. I don't mind if it goes down. It's there to provide that protection, but don't sort of stress it. And I think if you want to, have a little bit of a play on the speculative side, sure, then, silver is the leverage play compared to gold. So maybe weight a bit more into silver, or even look at platinum, which is undervalued as well. Or some of the emerging sort of green metals as well can provide a bit of upside, which I know you guys, Silver Bullion, sells. So those have some potential as well.
Okay, Bron Suchecki, before we wrap up, can you tell us more about your work and ABC Bullion?
Yeah, sure. I just sort of do the analysis at ABC Bullion, watch the markets, and at the moment I'm taking phone calls and helping pack stock because I'm so busy. So that's my new extended duties. So ABC Bullion's been around since 1971. It's got a refinery that's LBMA, Shanghai, as well as COMEX accredited. So we supply predominantly in the Australian market, and we export all of the rest of the stuff overseas, primarily into Asia because of the geographical location. And we also have a jewelry business as well. So it's a fully integrated sort of business, right from sort of the refining of the gold, making it into value-added products like jewelry, and then also into bars and coins for investment. So yeah, we get a full view of the whole gold value chain in our business.
Okay, Bron Suchecki, we thank you for your time. We wish you all the best, and we hope we can do this again soon, probably and hopefully under better circumstances.
Yeah, good to speak with you. Thanks.
That was Bron Suchecki from ABC Bullion sharing with us about his views of the global economy and the gold market. To learn more, please visit abcbullion.com.au. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And please do also check out the SBTV podcast on iTunes and Spotify.